The S&P 500 has took a battering these last few days. As you can see, it's down about 7% from its prior highs. If you look at the heat map of the S&P 500, a lot of things are down massively. Semiconductors are down, tech is down, Apple, Amazon, Google, Meta, all these things are down. But one sector that does look okay currently is consumer defensive. These are defensive stocks. They provide a consistent dividend and stable earnings regardless of the overall state of the market. Now, this is something that people do invest in. And one of the tickers here we can see is MO, which is Altria Group Inc. This stock here is a nice little green up recently. But yeah, overall, it is trading at $57.07 a share. Over the last year, actually up 37%. Which is very, very high, easily beating the S&P 500 over a similar time, and pays a massive 7.16% dividend yield. So what we're going to be doing is looking at Altria Group, taking it into my automated stock valuation spreadsheet, seeing if there's a buy or a sell using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. So firstly, we'll just put in the ticker MO, and this will load up all the MO, and this will load up all the latest company financials, and we can have a deeper dive. If you're interested in the sheet, check out my Patreon, but we'll talk about that more later. So $57 a share, 96 billion in market cap, a PE ratio of 8.72, meaning it is a lot lower than the market average, which has dropped slightly to 28.68. Earnings per share $6.54 and a beta of 0.58, meaning is a lot less volatile than the market. Analysts say it's about fairly priced, $56.36 a share. So back on that dividend, as said before, it is a dividend leader in the S&P 500. One of the aristocrats, 59 dividend increases in 55 years, 7.16%, meaning you'll get paid $4.08 a share. Is it a safe dividend? Yes, it is. 6.9 billion, and in terms of the net income, that's about 70%, and in terms of the free cash flow payout ratio, it's about 80%. And if you want to get paid this quarterly dividend, buy before the 25th of March, and you'll get paid. So let's have a look at the numbers here. We'll go to net income first, and you can see 23.53 billion, very, very consistent revenue. Ideally, we'd like this growing, but if we look back, this number is basically from 2009. The revenue has been relatively flat, little ups, little downs, but pretty consistent. Now, are they able to generate more profit out of that revenue over the last few years? The answer is yes, 10.29 billion. They were negative in 2019 and have sort of increased over those last 5 years, which is good, getting back to those prior numbers of 2016-17. Just interestingly here, if we did look at the share price over the last, we'll go max. 2017, it was $66 a share, had a big drop off. 2022 was 55, had a big drop off again, and is trading back up. So let's have a look at the free cash flow. Massive free cash flow generation, 8.5 billion, down from the all-time highs of 9.1. If we look at operating cash flow versus capex, very low capex, and operating cash flow is increasing, which is why the free cash flow is increasing. Just outstanding. What are they doing? Well, they're historically, well, as you can see here, they've always bought back shares, and they're continuing to do so, which is a way of rewarding shareholders. So let's have a look at the discounted free cash flow model. This is a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. So originally it's giving us a price of $112 a share. Let's take a deeper look and see if we agree with the numbers. Net income, where based on averages, we're expecting declining income. Let's see if this is close to what analysts are saying. I mean, as we've seen from 2009, revenue has been relatively flat. 20.3, 20.5. So we'll bring this down a little bit. We'll say it's even more declining, a bit more of a bearish case. Still $100 a share. Net income margins all over the place, but I think they have been increasing them, so we'll even keep it here. And this is where we'll see now. So net income to free cash flow rate, we'll take an average of these last few years. I think this is going to bring the price down quite a bit. $65 a share. This is also with the weighted average cost of capital. If we did look at the that number, we'd put it in 95. So let me just make this full screen again. Apologies. So discounted free cash flow, I would say it is a buy. Even in sort of the more bearish case, it is a buy. Before we continue, please check out my Patreon. Links are in the description. It's $4 tier if you're interested in the automated stock valuation spreadsheet. If you want the higher tier, it's $7. Or if you just want to help me out, $1.50 a month. But I would rather give you guys something than just giving me money for no reason. I would like to provide the service. And also like and subscribe if you haven't already. The channel is growing, but I wanted to grow more because I like doing these videos and it's fun for me, and hopefully I give you guys some value. But anyway, dividend discount model. You can see they have quite high growth. Weighted average cost of capital is low. $174. I don't know if I agree with that price. It's very, very big, but you can see the dividend discount model does really like this stock. And finally, Ben Graham formula for intrinsic value. Let's see. So this is earnings per share, PV, non-growth company, AAA bond yield. Let's see what they're saying in terms of growth. For Altria, I imagine it is not very high. 3%. Interestingly, it does have it as a buy. Fair value 60, grain price of 45. So meaning that, the grain price is kind of a, oh, wait a minute, 5.32. Oh, it's actually decreased a little bit, so this will go up. $62 a share. So Ben Graham thinks it's a buy as well, or he thinks he's a buy. So this kind of free cash flow model says it's a buy. Comparable company model says it's a buy. And the dividend discount model says it's a buy. So finally, we'll have a look at the comparable company model. This is where valuing stocks looking at their competitors. So let's have a look at these. I think the most closest would be PM Philip Morris. Another one, BTI, British American Tobacco. And I'm struggling to find another one. Let me just have a look. I'll just go to Seeking Alpha, comparable companies. Well, we'll maybe look at the sheet specifically with these two as well. See what Seeking Alpha says. I'm just doing this on another screen. RLX Technology. Sorry, let me just open that up. RLX Tech. Oh, it would help if I could spell. Okay, so they're e-vapor company. Well, we'll put them in. We'll see what they say. Let's see. Okay, cool. So what we're looking at is enterprise value, revenue growth rates, EBITDA, net income, profit margins, price to sales, price to book PEG, EV to revenue, EV to EBITDA, PE, and forward PE. Enterprise value, Altria is in the middle. Philip Morris and British American Tobacco will be higher. Revenue, the third highest, but sort of relative. Revenue growth rate, all declining apart from RLX, which, as I said before, is the leading brand in e-vapor technology. EBITDA, second highest. Net income, most profitable. That is good. Highest margins. Price to sales, market average, I believe, is just under 3 now. They're all above this, apart from RLX. Price to book, market average is 5, way higher. PEG, Peter Lynch's price to earnings growth. Ideally, you want this under 1, but you can see all higher. So now the specifics metrics that go in the model: EV to revenue, EV to EBITDA, PE, and forward PE. EV to revenue towards the bottom, EV to EBITDA towards the bottom, PE, lowest PE, and middle of the pack, forward PE, but it does give us a price of $83 a share. So all of the models do say it is a buy, but also one of the main reasons is people like the stock is it's a 7% dividend yield. Right, guys, thanks for watching. Please give a like on the video if you enjoyed. Subscribe if you're not already. Check out my Patreon, and I'll catch you guys in the next time.